Thanks for clicking! Canada's economy is showing signs of weakening. This according to a recent release from Stats Canada. In the immediate aftermath of the release, predictions started coming out that we've seen the last of the Bank of Canada's rate hikes and that the bank would be holding interest rates steady at its September announcement.
Have I ever steered you wrong, Jim?
But I think it's worth noting that this is not the first time that we've seen positive signs of a slowing economy in Canada. Re-accelerate and interest rate hikes follow. Regardless, if we are finally in the early stages of an economic slowdown, that doesn't necessarily follow that interest rate cuts are coming to a theater near us anytime soon, regardless of the predictions being made even before Stats Canada's release. Absent a financial crisis, interest rate cuts can take a long time. So what I want to do today is go over the StatsCan release on the Canadian economy, take a look at what the economy usually looks like when we do see interest rate cuts, and then discuss what to look for next. Speaking of next, it is the end of the month, so we're expecting to get July's real estate data released by the local board sometime later this week, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into Canada's economy. Onto the economy. As mentioned, Stats Canada's release showed that Canada's economy had grown by 1% in the second quarter, with preliminary estimates showing that real GDP, Canada's GDP adjusted for inflation, had shrunk by 0.2% in June. BMO's Doug Porter told Global News that Canada's economy is probably in for a hard-ish landing.
I think what I would say for Canada is we're looking at a hard-ish landing here. Not really a full on recession, but as you say, a bumpy ride.
BMO's Robert Kavchuk, who attributed the 2020 and 2021 housing bubble to free money rather than supply, noted that we are indeed seeing signs that a recession might be in the offing.
We're kind of starting to see some evidence that almost 500 basis points of tightening compressed in a very short window of time is starting to have an impact on the economy more broadly. And we're seeing it in areas like housing. We're seeing it in areas like consumer spending, where spending volumes at the retail level have really flattened out, even though we are seeing very strong demographic and population flows.
And Desjardins noted that with a slowing economy, the Bank of Canada is no doubt done with interest rate hikes.
The Bank of Canada will not raise rates any higher. It has done enough to start to bring inflation down.
But does that mean that rate cuts are in the immediate offing? If the recession does come, if we are in for a hardish landing, does that mean we'll be seeing rate cuts almost imminently? Not necessarily. Stagflation, where we have an economic slowdown but elevated CPI, is still a real possibility here in Canada. Even as a potential economic slowdown is upon us, gas prices in the US and here at home are spiking. The collapse of the Black Sea deal could put upward pressure on food prices, and economists are continuing to worry about a wage price spiral, all of which can and will put upward pressure on the CPI. With that said, let's say that all of that doesn't happen. Gas prices stay low, the Ukraine crisis is resolved, and food prices come down or stop rising, and we don't get a wage inflation spiral. Will we be getting immediate interest rate cuts? What do the economic conditions in Canada usually look like when rate cuts are upon us? The last non-emergency interest rate cut that Canada saw came in January of 2015. Back then, Bank of Canada Governor Stephen Poloz shocked the markets when he lowered interest rates in January of 2015, due in large part to concern over plummeting oil prices and the drag that they would have on the economy. Back then, the unemployment rate was sitting at 6.7% and inflation was sitting around 1%. So, we had a surprise rate cut in January of 2015, unemployment was sitting at 6.7% and the CPI was at 1%. Prior to that, the last non-emergency rate cut that we saw came in July of 2003. Yep, in the last 20 years, we've only had one interest rate cutting cycle that wasn't due to a major global emergency.
You're doing a heck of a job there, Brownie.
Regardless, back in July of 2003, when we got that interest rate cut, the unemployment rate was sitting at 7.7% and the CPI was at 2.08. So, in both 2003 and 2015, the last time we saw non-emergency cuts, the unemployment rate was well above 6% and the CPI was sitting at 2% or lower. Fast forward to right now, and Canada's unemployment rate is at 5.4% and the CPI is sitting at 2.8% and set to rise as base effects continue to dissipate. And the 5.4% unemployment that we have right now, where the economy stands now, is a long, long way from the 6.7% that we had in 2015 and even longer from the 7+% we had in 2003. If we look back in the last 20 years, absent major shocks, unemployment rates don't rise or fall very quickly. It takes a lot of time. So, if the past 20 years is any guide, for us to get those rate cuts anytime soon, unemployment is going to have to rise and rise substantially, and the CPI is going to have to reverse and reverse quickly. And as we noted when the CPI was released earlier this month, Canada's prices have already risen by 2.7% just since December. So, if prices stop increasing right now, if we see no more price increases on anything over the next 5 months,
I can see that happening, yes.
then come December, our inflation rate should be sitting at 2.7%. Still not within target range, and still not enough for the Bank of Canada to be able to cut rates. In summary, if we don't see stagflation set in, if gas prices slow, if the Ukraine crisis is resolved and food prices don't rise further, and if we don't see a wage price spiral that the Bank of Canada has warned so much about, then we are still a long way away from the unemployment rate and the CPI being at the point that the Bank of Canada will be able to cut rates based off historical data. And it's not that we won't be seeing interest rate cuts. Indeed, we will, eventually. But I think there is a real tendency on the part of many to think that free money is the norm upon which we are imminently returning. And that's just not the case. As mentioned, when interest rate cuts came in 2015, many were surprised. The markets were caught off guard. Because back then, at least for many, the powers that be, the usual suspects, the media, didn't consistently tell us that free money was the norm, that free money was the natural state of things and would be coming back to a theater near us imminently. So, in summary, although the data has been wrong before, it does appear to point to a Canadian economy that is slowing down. With that said, with an unemployment rate under 6 and a CPI at 2.8 and set to rise, we are a long way away from where the Canadian economy has been in the past when we saw those interest rate cuts. And as such, it could be a long time before those interest rate cuts, which so many are hoping for, so many are predicting, actually come to the Canadian economy. We'll obviously continue to track the Canadian economy and the Bank of Canada on this channel. Click like and subscribe if you want to get those updates. But for now, thanks so much for watching.